Hey guys, hope everything's going well. All right, I just wanted to let you know on my other channel, Sports AIH Sports, I'm going to be doing a live stream tomorrow night. So those that are interested in sports cars, make sure to check it out. Now, I wanted to touch base on the stock market. The stock market has taken a dive a little further below than where I thought it would have gone. But here we are. It's an ugly day on Friday. What S&P is what 400 or 4012 or something around there. I've been looking at technicians and some on the Elliott wave side. They said that it could even go a little lower to about 4,000. This is not investment advice. This is just me speaking. Just make sure to do your own due diligence before investing, speculating, etc. And I'm just looking at it from a sentiment perspective. The sentiment is very, very, very bearish. And me being the contrarian, whenever I see sentiment this negative, or if I look at sentiment, it's very optimistic, in my opinion, especially right now where I don't believe the US is going into the recession right this moment, okay? I think that's going to happen about 2024, 2025. I've stated this on my sports car channel, and I've stated this probably here. And ultimately, the yield curve is still upward sloping, the Fed funds rates versus the 10-year note. As long as that's upward sloping, in my opinion, the economy will continue to grow. I mean, it didn't grow first quarter. We were locked down technically. I mean, I wasn't back into the office until what, mid March, something like that. So, and there's like a few months, where they say, okay, work from home. Now it's a hybrid situation. I think that's like that throughout the US for those that can work from home. Now, if we're just looking at the bearish sentiment in the bull bear spread, I believe that's what it's called. It's negative 43. And if you look at in 2009, it was minus 51 or minus 53. It's getting very bearish out there, okay? And we know the market bottomed out in March 2009. And a lot of people say, hey, they're raising rates. That's why it's very bearish out there. People expect more pain. There could be more pain. But that being said, I rely on sentiment to take the opposite side of the trade when it's appropriate. And just because I've been bearish on sports cards doesn't mean that I won't be bearish on other assets. I may be bullish. I am bullish on equities. Now, could I be wrong? Oh, yeah, I can be wrong. But ultimately, I'm looking at one of the most extreme indicators. I think last time was 1991 as well. So 1991, you're looking at 2009, and then today. Extreme bearish conditions in the bull bear spread. I want to buy myself. Now, there are a few other underlying conditions out there. The dollar index is very strong right now. Yeah, we have inflation, okay, no doubt about that. But just from looking at the dollar index, it's at 103, okay? And I talked about this on my sports car channel today. I expect a reversal in the dollar index from a technical perspective and also a fundamental perspective. The dollar index consists about close to 60% of the euro and then about 10% of the yen. I think it's maybe like 57% of the euro. Okay. So 57% plus what, the yen, 10%. So you're talking about close to 70% of the dollar index consists of two currencies, the euro and the yen. And if you look at these two currencies, they have been oversold. So if these currencies start to go the other direction, the dollar index has a higher probability of going down, in my opinion. And that would be bullish for gold, for silver, probably Bitcoin, and in my opinion, equities. You can see as the dollar's been going up, the equities have been pounded. And right now, the traders are like, okay, strong dollar, and they're going to sell off stocks, okay? And some sophisticated traders, investors, maybe long or short the euro, maybe short the yen, and maybe long the dollar futures is probably because the Federal Reserve is raising rates. And if you just look at it from what some futures trader told me, he said that the dollar index, or if you look at Forex, they look at interest rate differential. So if, for instance, country X is raising their interest rates while country Y isn't, uh, people may speculate that the country that has the rising interest rates, they're going to bet on that currency. Now, that's just one way of looking at Forex. And there's other things, trade deficit, they could look at that, expanding deficits, et cetera, et cetera, et cetera. But this is what the futures trader told me, okay? And I looked at that, an interest rate differential. I could see why people have been shorting the euro because the euro right now has actual negative interest rates. Their short-term interest rates negative 50 basis points. In the US, it's 25 basis points, and the US is going to raise interest rates even further. To what extent, I don't know. But here's an interesting news that came out. The ECB announced that they're going to start to raise interest rates this year because of their inflation problem. So, if they're going to raise interest rates, and then maybe the US comes out saying, "Okay, we're going to raise interest rates but not as much as we've stated." These forex traders, what they may do is they're like, "Okay, look, we haven't priced in these interest rate hikes in Europe, but we've overpriced the interest rate hikes in the US." So thus, euro goes up, and that puts downward pressure on the dollar because the US dollar index consists a huge part of the euro. And that's what I'm looking at right now. And the ECB does have nasty inflation, about 7%. Not as bad as the US, because I think the US inflation is a little higher than what the CPI numbers are stating. There's problems with the geopolitical situation. That made it much worse than what I thought it would initially be. So, all of these things coming about, I expect a reversal in the dollar index, and that should help the stocks because you have to also realize that a lot of the stocks have their operations overseas, especially these big cap companies. They always talk about the need for a weaker dollar because that helps their exports, right? Whether you agree with it or not, this is what the establishment thinks. That's how they think like. So if they get the weaker dollar, that should help corporate earnings in the short run. I'm not bullish long term on the stock market though. So don't get me wrong. I do still think bad things will happen 2024 to 2025, but time will tell if I'm right. Anyways, guys, let me know what you think about this. Smash that like button, subscribe if you haven't, and comment down below, guys. Thank you. Bye.